China's comprehensive overhaul to resuscitate its faltering property market. In a bold move to resuscitate China's slumping property market, Beijing has unveiled a comprehensive package of measures that encompass interest rate cuts, eased down payment ratios, and the conversion of unsold homes into affordable housing. This unprecedented intervention aims to restore confidence in the sector and stem the decade-long decline in housing prices. The People's Bank of China, the country's central bank, has announced the elimination of the minimum interest rate for mortgages. First-time buyers will now be able to secure mortgages with a down payment ratio of 15%, while second home buyers will face a down payment ratio of 25%. Additionally, the bank has created a 300 billion yuan, £32.8 billion, facility to support state-owned companies in purchasing homes at reasonable prices. These measures follow a series of unsuccessful attempts by the Chinese government to stabilize the property market, which has been reeling since the 2021 default of Evergrande, once the second-largest property developer in the country. Evergrande's subsequent bankruptcy filing in New York and liquidation order in Hong Kong fueled concerns about a wider credit crunch. The property market's decline has had severe consequences. Over 5 million people are facing potential unemployment due to halted construction projects and developer defaults. Protests have erupted across the country, with over 1,770 demonstrations related to housing recorded between June 2022 and October 2023. Homeowners and buyers have voiced their frustrations over delays, alleged fraud, and poor workmanship, while construction workers have demanded unpaid wages. Prior efforts to boost the property market have had limited success. Despite the average interest rate on newly granted mortgages falling to a record low of 3.69% in the first quarter of 2023, demand for housing has remained sluggish. Some analysts believe that further interest rate reductions may not stimulate demand sufficiently. The impact of lowering mortgage rates would be limited because there's still a lack of demand, and that's why we need government to be the buyer as a last resort, said Larry Hu, the chief China economist at Macquarie. At its peak, the property sector accounted for around a quarter of China's economic growth. However, the current crisis has put the country's growth target of 5% in 2024 at risk. Analysts estimate that at least 7 trillion yuan in central funding support would be required to normalize the inventory of unsold housing. This figure far exceeds the 300 billion yuan facility announced by the government. The likely scenario is a faster recovery in large city property markets over the next year or so, but with the rebound in smaller cities trailing behind over several years, said Duncan Wrigley, the chief China economist at Pantheon Macroeconomics. Despite these measures, the path to recovery for China's property market remains uncertain. Retail sales growth and industrial production have underperformed expectations, suggesting that the economy still faces significant challenges. Beijing's comprehensive intervention is a testament to the severity of the crisis and its potential implications for the Chinese economy. While it is too early to predict the effectiveness of these measures, they represent the government's determination to address the crisis and restore growth in the property sector.